projects will be considered. First one is independent projects are projects that, if accepted or rejected, don't affect the cash flows of other projects. The second one, mutually exclusive projects, are those projects that, if accepted, preclude the acceptance of all other competing projects. This is two types of capital budgeting. Making capital investment decisions. A sound of capital management will earn back its original capital outlay over its life and at the same time provide a reasonable return on the original investment. Managers must decide on the acceptability of independent projects and compare competing projects on the basis of their economic merits. To make a capital investment decision, manager estimate the quantity and timing of cash flows, assess the risks of investment, and then the last one, consider the impact of the project on the firm's capital's profits, or maybe capital increasing. Data analytics and capital investment models. Two key components of data analytics for capital investment decisions are forecasting the quantity and timing of future cash flows. Selecting and use analytic models to guide managers in the acceptance or rejection of potential investments. And then cash flows used for capital investment analysis should be after-tax cash flows. And then analytic models help managers assess the risk and profitability of proposed projects. Guys, there is a question discussion activity first, discussing the difference between independent project and mutually exclusive project. I want to listen. What about these questions? Oh, let's see. Is there any ideas? The difference between independent projects and mutually exclusive projects. Okay. Okay, let's begin answering my question to my question. Difference between independent project and mutually exclusive project. Independent project is such that acceptance of one does not preclude the acceptance of another. This is independent project. Mutually exclusive project, acceptance of one precludes the acceptance of the others. This is the main difference between them. Basic capital investment decision models can be classified into two major categories. First category is non-discounting models. Ignore the time of value of that money. And then second category is discounting models explicitly consider the time of value money. This one is if non-discussing, this is negative for time value of money. Discounting models explicitly consider the time of money. Non-discounting models, first of them is payback period. Payback period is consists of for using this model, non-discounting model is time presents the time required for a firm to recover its original investment and then often used to in assess financial risk, impact of investment on liquidity, and then obsolescence risks, impact of investment on performance measures. How can we determine payback period? Payback period is the cash flows of a project are equal. If the cash flows of a project are an equal amount each period, the payback period is computed as follows. That is, determination of payback period is equal original investment divided by annual cash flow. There is an example, maybe we can use just non-discounting model payback periods. If the cash flows are unequal in some years, independent days, another times, another region, and then another amounts. The payback period is computed by adding the annual cash flows until such time as the original investment is recovered. If a fraction of year is needed, it is assumed that cash flows occur evenly within each year. There is an example. Suppose that a new car wash facility requires an investment of 100,000 and the either has even cash flows of 50,000 per year, or B category, the following expected annual cash flows is equal to 30,000, 40,000, 50, 60, and 70,000 in dollars. Required, calculate the payback period for each case. First case is even cash flows of 50,000 per year. First, solution to A category, each case, payback period is ordinary formula original investment divided by annual cash flow. Then our new car wash facility is for this investment 100,000 divided by every year or per year we have 50,000 in dollars. Divided equal is 2 years. There is a schedule, like table, for the case of B. For the case of B, year, we have 5 years because of there is 30K, 40, 50, 60, 70K in dollars. Uncovered investment, beginning of the year, we have 100,000. And then annual cash flow, the first year, 30,000, the second year, 40,000, 50, 60, 70. Time needed for payback years for 30,000. If we pay back, we will do our payment 100,000 minus or 30,000, it will be 70,000. For the second year, we have, beginning of the second year, we had unrecovered investment 70,000. And this year, annual cash flow, we have 40K, 40,000 in dollars for the second year. And then we have 70,000 minus 40,000 equals 30,000. The beginning of the third year will begin with 30,000 unrecovered investment because of here is 40,000 and here is 50,000. 30,000, for 30,000 we have annual cash flow, we have 50,000, and then during the during period of 0.6, we had not a year, but 0.6 year. What does it mean? It means 7 months and then extra days. We will do. And then we had 20,000 in dollars. And then also the fourth year, we have beginning of unrecovered investment, there no available. And then we have annual cash flow 60K. And then the fifth year, we have also no unrecovered investment, and then 70K. Hope. Using the payback period to assess risk. One way to use the payback period is to set a maximum payback period for all projects and to reject any project that exceeds this level. Some analysis suggests that the payback period can be used as a rough measure of risk, with the notion that the longer it takes for a project to pay for itself. Firms with riskier who has a high risk cash flows in general could require a shorter payback period than normal. Firms with liquidity problems would be more interested in projects with quick paybacks, but not long time periods. Another critical concern is obsolescence. Firms with a higher risk of obsolescence, such as computer and MP3 player manufacturers, would be interested in recovering funds rapidly in short time. Payback period can be used to choose among competing alternatives. Investment with the shortest payback period is preferred over investment with longer payback periods. This measure suffers from two major deficiencies. It ignores the cash flow performance of the investments beyond the payback period. It ignores the time of value money. Accounting non-discounting model from the categories. Accounting rate of return. Accounting rate of return is shortly we call is ARR, non-discounting model. It means measures the return on a project in terms of income as opposite to using a project's cash flow. May be useful as a screening measure to ensure that a new investment doesn't adversely affect the convenience. Covenants. Covenants may use accounting ratios that can be affected by the income reported and the level of long-term assets. Here is how to compute it by formula. Accounting rate of return, it's called maybe ARR, equal average income divided by initial investment. Here is example for computing for determining accounting rate of return. An investment requires an initial outlay of 100,000 and has a 5 with no salvage.
Iya. Eh,
Is it okay?
Oke, Mister.
Yes. Can I go on? Is there any answer? Is there any question? Okay, let's go on. An investment requires an initial outlay of 100,000 and has a 5-year life with no salvage value. The yearly cash flows are 50K, 50K, 60, 50, and 70K in each year. Required in this example, calculate the annual net income for each of the years. The first one. The second one is calculate the accounting rate of return. And then solution. Yearly depreciation expenses is um, 100,000 minus 0 point because of no salvage value. That's why we minus no. And then divided by 5 years because of the it has 5 year life. And then it will be yearly depreciation expenses. We had 20,000 in dollar. Annual net income, we do the first year 50,000 minus 20,000. It will be 30,000 will it in net income. It's in initial outlay, what it says. And then annual net income, how we calculate this in this formula, we can use net cash flow minus depreciation expense. Second year net income, we have 50,000 minus 20,000, it will be 30,000. Third year also 60,000 minus 20,000, it will be 40,000. And then fourth year 30,000 also, and then 5 year 50,000. If we to determine total net income, all of them we added together 30, 30, 60, 40, 100,000, and then 180,000. Here is the for we determine total net income for calculate the accounting rate of return. There is average income we need. We need average income. That average net income, we use 180,000 divided by 5 because of their 5 year life. That's why we need 36,000. Each year, average net income, we had 36,000. Accounting rate of return, ARR, average income divided by initial investment. Divided initial investment, we had an initial outlay of 100,000. 36,000 divided by 100,000, it will be equal 0.36. It means 36 percentage of the investment we had rate of return. Limitations of accounting rate of return. Unlikely the payback period, the ARR does consider a project's profitability. ARR has other potential drawbacks, including the following this. First one, ignoring time of value. In ARR, we need ignore time of value money. Second one, like the payback period, it ignores the time of value of money. And then next one, error and payback model are referred to as non-discounting models because of they ignore the time of the money. Limitations also dependency on net income. Error is dependent upon net income, which is a financial measure most likely to be manipulated by managers. Managers' initiative is because bonuses to managers often are based on accounting income or return on assets. Managers may have personal interest in selecting investments that provide the highest set income in the short term rather than one that produce the greatest cash flows and returns in the long term. Knowledge activity, not first, this is the second one. Here is like testing your knowledge. An advantage of ARR over payback period is that it for you can answer. Can you maybe you choose your pick one only truly answer. A answer is considers the time value of money, measures the value added by a project, is always an accurate measure of profitability, is more widely accepted by financial managers, considers the profitability of a project beyond the payback period. Dear students, can you hear me?
Yes, we can, Professor.
Okay, there is a question. There is a question. An advantage of error over payback period is that what do you consider? Which answer is correct? I will answer your question. Okay. An advantage of error over payback period is that the correct answer is E, considers the profitability of a project beyond the payback period. The net present value method. In short region, we can use NPV method. Discounting models use discounted cash flows, which are future cash flows expressed in terms of their present value. One discounting model is a net profit value, present value, methods. It's in shortly NPV, we called. NPV is the difference between the present value of the cash inflows and outflows associated with the project. Here is uh, the formula computing of NPV neutron. It is like this. Varies. This is the present value of the project cost is it's called in E, and then we need SFT, the cash inflow to be received in period T, with the T is equal 1 to N, and then little e, the required rate of return. We need the time of period and the present value of the project future cash inflows. Here is in from computing formula. NPV measures the profitability of investment. A positive NPV indicates that the investment increases the firm's wealth. To use the NPV methods, a required return of must be defined. Required rate of return is the minimum acceptable rate of return, referred as discount-free rate, hurdle rate, and cost of capital. If you need this, there is a link to useful information. You can use that. If future cash flows are known with certainty, then the correct required rate of return is the firm's cost of capital. Managers often choose a discount rate higher than the cost of capital to deal with the uncertainty. If the rate chosen is excessively high, It will revise the selection process toward short-term investments. Once the NPV for a project is computed, it can be used to determine whether or not to accept an investment. If the NPV is greater than zero, the investment is profitability and therefore acceptable. Positive NPV signals that first initial investment has been recovered. Required rate of return has been recovered. Return in excess of first for information and then second information has been received. Okay. If the MPV equals zero, the decision maker will find acceptance or rejection of the investment equal. If the NPV is less than zero, the investment should be rejected. In this case, it's earning less than required rate of return. Here is example. How to assess cash flows and calculate the net present value. Okay, a detailed market study revealed accepted annual revenues of 300,000 for new earphones. Equipment to produce earphones will cost 320,000. After 5 years, the equipment can be sold for 40K. In addition to equipment, working capital is expected to increase by 40,000 because of increases in inventories and receivables. The firm expects to recover the investment in working capital at the end of the project's life. Annual cash operating expenses are estimated at 180,000. The required rate of return is 12% in percentage. Required estimate the annual cash flows and calculate the NPV. Here is we have step first for the solution, cash flow identification. Identification if we need. Okay. Then cash flow identification, first year, we have equipment for 320,000. Working capital is 40,000 because of after 5 years, we need to product sold to 40,000. It will be total 360,000. Revenues, we have revenues annual 300,000. Okay, operating expenses, we have annual cash operating expenses 180,000. Total, we need 120,000 with expenses. Revenues 300,000 for the 5th year. Operating expenses 180,000, and then salvage 40,000. Recovery of working capital also 40,000 because of in addition working capital is expected to increase by 40,000. And then also total for the fifth after the 5th years will be 200,000. Here is 300,000 minus 180,000 it will be 120,000. 120,000 plus 40, 160, and then plus 40, it will be 200,000. Here is continue of example MPV analysis. The first year we have 3,600 cash flow. We have discount factor. It's called like a index B. And then present value cash flow. We have also here is explanations for the schedule table. Schedule table, we have this. The first schedule is present value of single amount. First figure, first table, first, and then second one, present value of an annuity. Here is, we use this information about index capital, cost of capital. We need to use this figures out from step 1 is A cash flow statement, and then from B for B exhibit from 12B to 1. Here is 12B to 1, present value of single amount, and then also we need to use present 12B2, present value of annuity. We have two cases for solve this problem. Step 2A, MPV analysis, cash flow. Each year we have 120,000 because of the variances. Here is, we need to total revenues. We have operating expense from first year to fourth year. We had 120,000. Here is, and then the last year we have total revenues to.
I'm sorry, sir. Let me, sir. The share screen is not showing.
Showing?
The share screen is not showing.
Presentation is not showing? Or
Yes.
me not? Okay. Is it okay?
Yes, sir.
Музыка чуть. Have you heard about my explanation on this page? Dear students, have you heard my explanation on this page?
Oh, yes, sir.
Okay, and then the next one.
Yes.
Yes.
This is also known.
Yes, it also, sure.
Okay. And then this is our table schedule for present value, determining calculated present value of single amount. Here is periods in horizontal line. We need percentage, amount of investment, return percentage. Here is period in vertical. In I think in years we need to learn it. And then this one we used it. Here is, we use discount factor. discount factor maybe maybe the fifth year 200,000. We use this table. 200,000 and then this factor from 12B1. 12B1 we need the fifth year. I'm sorry. Here is, oh, I show like pen. Okay. Is it okay? No. No. Here is. Oh, we need the fifth year. Also, we use pen. Another color, maybe not blue, green one. I use green one. Here is 12% and then fifth year. Here is. This measure we copy out to our here is 0.56743. 0.56743. Is it okay?
Sir, may I ask something?
Okay.
What is the best timing for payback period for small firm?
Okay. Thank you for your question. The short time. Okay. How I'll explain it. Payback period. What is the best time? It depends on the small companies. For the small companies, it depends on to break even point. Small companies, we need to determine how to get to break even point from the salaries, maybe from the sold of goods, maybe sold of another products. It means break even point. It depends on the break even point of this small company. Maybe assuming maybe company A, we need we need to company A investment we million in dollars break for short time, maybe in small companies. To save the companies, I'm sorry, we need to every year, 250,000, $250,000 in dollars. We need invest for $1 million companies. Maybe it's not small companies, but it will be very not large company. We are at payback period of the year in 4 years. If we invest from 250,000, it will be payback period is 4 years. Maybe in small companies, I don't know. A small companies, it only depends to break even point. If we calculate it correctly, maybe I think in 2 years. But it is not fixed measure. It's something else. It's according to their strategies, according to their capital budgeting system, according to the sell product system, and then also cost, volume, profit analysis also affects to determine this payback period.
Okay, sir, thank you.
Okay, you're welcome. Is there any question?
Excuse me, sir.
Okay.
I ask something about knowledge tonight. First of
Mhm.
all, let me introduce. My name Nadia Nadirotus, but sir can call me Nadia. But I say sorry for the first because my English is not too good for speak, maybe. And I say thank you for knowledge tonight, so inspired for all. My question is, can all types of investment be calculated using the same method, or is there a suggestion that different investment require different calculation methods? Because as far as I know, investment have different cash flow characteristic, risk, time horizon, and investment goals. In fact, each investment analysis method, NPV, IRR, payback, ERR, has its strengths and weakness, making certain types of investment more suitable for certain methods. In this economy, which investment might be suitable if combined with the formula you just explained? What do you think, sir? Any three question? I need three question for me. Thank you.
3 questions for answering. Yes. Okay. First one is, I think it is in different code. I switched off. Beresme. Okay. First of all, to thanks for your questions, and then in our lecture in investment schemes, we need to calculate not only one method, there are more extra methods for determining payback periods for the investment. And then also there are more factors affect to this determination of payback periods. In every companies, we need to learn NPV analysis, and then also there is in my here is I will show you internal rate of return analysis also. And then here is, and as we need to determine of our benefits, post out benefits, and then also project present values. We need, here is NPV analysis, also IRR, internal rate of return. NPV depends on absolute in quantities. IRR depends on relative percentage. And then also we have methods of first we can use it for determining capital budgeting. We need annuities also. Here is if we to get in future how much investments nowadays we need to how much put in for investment. Maybe here is knowledge check activity. How much will we receive in 2 years if we invest right now this investment percentage quantity? And then next one, if now in this period we how much put the money for the to get in future this double time or maybe double quantity of money. And then also this is self-assessment. Here is present value concepts also. We compute, calculate f like p multiply then 1 plus e and then comma is n in present value. We have more extra values, more methods for the determining payback periods. It is more factors also influence to our company's rate of ratio and then assess risk, maybe internal rate of return also. Are you hearing me, dear students?
Yes, sir.
Yes. Okay. First of all, we need to learn to investment decision making decision. We need first I remember about it non-discounting models and discounting models. In every models we have various different ways of calculating investment payback periods. First, non-discounting models we need to learn payback periods. It depends on their first time. It is present time required for a firm to recover its original investment. It doesn't matter how it will be in the future. Payback period, original investment, annual cash flow. We determine in last like this for all. Formula payback period equal is original investment divided by annual cash flows. Okay, guys. Any questions?
Thank you, sir, for your answers.
You're welcome.
Sir, excuse me. I wanna asking. Excuse me, sir.
Okay, I'm hearing you.
Okay. Uh, the if at the end of an analytical process we discover that the final result contains error, the key
Uh-huh.
challenge comes identifying where in the sequence of the step the mistake occurred. What is the fastest and most effective way to trace back through the analytical workflow to pinpoint the exact of step where the error originates? Should we rely on systematic backtracking or error checking tools or peer verification or another method? And how do we balance speed with accuracy and when the correcting analytical mistakes? That's my question, sir.
Okay. We need to learn this is I think your question is about uh, what's the
Uh,
comparison? Yes, compare to time of investment. Yes.
no, no.
No, no.
Ini.
Okay, please, excuse me. Can you write in our chat group?
But,
Here is in a question, and I know what is the best timing of payback period for small firm. Oh yes, I think I answered also in Diane Ferlina. Yes,
yes.
no,
And
yes. Okay, yes. I answered the last one. I think your message. I am waiting for you.
okay, I'll send. Excuse me, sir. I'll send the message on group message. Sorry, sir. Excuse me. Maybe your mic is already off.
I am sorry. I am sorry. My
It's okay. It's okay.
real factor. I understand. Okay. Thank you for your questions, Mrs. Sukma. I think yes. This in our period, in our system, in our work time, we not seldom, often, but often we um, came across to errors in laboratory information system. Laboratory information systems, maybe we are our in our investment project, our financial management, we don't know where we had mistaken, and then where we can use how we do our find our mistake where it's, but we first our works we did it, and then also after that we need also check the process, analytical process or analytical workflow once more. Here is a I think solution. Here is solution of this problem, some problems. How do we solve this our errors? How we solve this our errors conclusion? Here is first of all, we learn to determine which errors we have came across. Our error factors also related to system development, and then also fails to affected information use, and also we have also factors. One of the most effective factors is our using the system. If we don't know where how to put the numbers, how to put the debit credits, maybe systems, maybe trials, how put to this here is system our mistakes. That's why we need to first of all determine where is how we made this mistake, and then also we can solve the project. And then second one, what is the fastest and most effective way to trace back through the analytic workflow? Okay, okay. The fastest and most effective way is, I think, for investment, for projects, we work in teamworks, not only one, but in teamworks. Teamworks, maybe I do my side of analytic process, and then the next side will do another analytical process, another percentage, and then this another person also use my methods, also use check my points, and then he will continue to do it analytical process. Other way we cannot do the faster and then most effective way. We have, I think it's my opinion. And then say next one, should we rely on systematic backtracking, error checking tools, peer verification, or another method? Nowadays, it's very popular system is double verification system. Double verification system. It's also we put our information not only in our social systems, but also in our cloud systems, maybe cloud information technologies. We know it. If we will pass away after 50 years, maybe after 100 years, they also working on clouds. And then how do we balance speed with accuracy when correcting analytical mistakes? This is such a frequently used questions, such a frequently used. This question is also how we can do correcting analytic mistakes in doing balance sheet with accuracy. Balance sheet with accuracy, we do also to analyze how we do our trial system. Trial system is debit credits. Balance sheet, maybe we can use not only in one side, in not only first time documents, but also we have like a double verification, another side of documents. We can use it. We can use our analytical methods, analytical determination. We use not only one side, also to the double side. That's why we have do balance sheet. To do balance sheet, we have some more problems when we doing mistaken, and that's why we are correcting this analytical mistakes. I think this one. Okay. Okay, guys. We have, yes. Our time will be including to close, and then our time is up. I think you have more useful information about your cost of capital sim, and methods also will be useful for you in your future. And then we can meet in after 2 weeks, I think, in 2 weeks, and then that's all our lessons. Okay, guys, goodbye. See you next time.
See you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.
You're welcome. Thank you.